Today for our Big Ideas episode, we have Dr. Vardhan to talk to us about consumer credit. Recently, RBI made some regulatory changes on consumer credit and revised the risk weight on unsecured consumer credit to 125% from 100% previously. And there, and he's going to talk to us about what it means on the banking industry in general and how consumer credit is affected by a lot of these factors. So, Dr. Harshvardhan, please begin.
Yeah, so I think you have to view RBI's action as a reaction to what they saw happening in the banking industry. And what was happening is that the consumer credit has been growing very, very rapidly. If you look at last decade, from financial year 2014 to financial 2024, the total consumer credit in the banking system grew at about 18% compounded annual growth rate, in contrast to the overall banking credit growing at about 11%. So basically it has outpaced other segments of credit. What is noteworthy that within consumer credit, the unsecured credit, which is credit which is given without any collateral, which is primarily credit given through credit card and personal loans, that grew at about 22% compounded. So such a sharp growth is something that perhaps alarmed RBI, and therefore the instrument that RBI has to actually curb any bubble from developing, if they see one, is to increase risk weight. Because what happens if you increase risk weight is bank have to put more capital behind all the incremental loans that they give, which kind of reduces their both appetite and profitability on those loans. So the assumption is that therefore the growth of these type of credit will slow down. So this trend has been going on for the last decade. It probably accelerated a lot during the COVID period, but generally speaking it started way before that, around 2014, 2015. It is important to note that industrial credit, so if you look at credit to industry, it grew at about single digit, about 8% during that time. So clearly Indian banking has moved away from lending to businesses to lend to consumer. And that's a very important trend which has many, many implications. The most immediate one is the RBI action that you talked about, but there are also other broader, longer term implications of this move. So now the question is, why did this happen? What were the drivers of banks moving essentially away from lending to businesses to lending to consumers, and within that lending in an unsecured manner? So I think there are multiple factors that you have to look at. The first is that if you remember in the early 2010 there was a NPA crisis in Indian banking, which went on almost until 2018. But it peaked in 2016 when the RBI did something called asset quality review. It forced banks to recognize a lot of non-performing loans and provide for them. What that led to is a significant increase in risk aversion of banks. So banks basically started saying, look, lending to commercial businesses is risky. We don't want to do it. We want to bring down our risk. And consumer credit was seen to be much less risky than commercial credit. Now, it's another matter whether it is so, but that was the belief, and that's what led to this transition. It is also important to note that because of the general slowdown in economy, if you remember 2016 onwards, we saw a bit of a slowdown. It was accelerated post demonetization and GST implementation. The demand for industrial credit went down, business credit went down.
It's also counterintuitive, right? That these kind of loans are basically unsecured and collateral free.
Yeah, so we'll come to that, because what we saw in the first few years, let's say from 14 to about 18, 19, there was almost a balanced growth between secured and unsecured consumer credit. What is secured credit? Secured credit is typically credit given against an asset. So for example, a best example is home loans. If you buy a home and take a loan, that you know that the bank takes charge on the loan, charge on the home, which is the security. Or more common is gold loans. So people, when they need money in emergencies, pledge gold, which is again considered secured credit because there is a security. Vehicle loan, which also is a security but of a lower quality, is not as strong as, let's say, gold. Whereas loans that are taken under credit card or personal loans have no security. Now, we have to bear in mind that from a lender standpoint, there are two important dimensions of a loan. This is I'm talking about consumer credit, which are very critical for a lender to manage risk. One is security that we talked about, whether there is a collateral or not. But equally important is something called end-use control. So what happens in, let's say, in a home loan or in a vehicle loan or in a consumer durable loan, people take loans for TV and fridge and so on, is that there is a security, okay, of different quality. Home is a much higher quality security than, let's say, TV. But there is an end-use control because the money is given when you buy that asset. So the lender knows that the money went to for the buying of that asset. What happens in other kinds of, especially unsecured loans, that number one, there is no security, but also there is no end-use control.
I can use my credit card for whatever I want.
Whatever, but especially personal loans. I can take money and party. In fact, the big worry that I imagine RBI may have had is that a lot of people are borrowing money to play in the stock market, which is extremely risky. It's like borrowing money to play poker, essentially. And so that is why this rise of unsecured credit is worrisome or could be a cause of concern. There's another issue, which is that in all the unsecured credit essentially goes for consumption. It does not go for acquisition of asset by definition. And so one possible reason for this is that people are consuming more than they are earning. In other words, when everything is available on credit, you really end up buying way more than you should be buying. And that there is anecdotal evidence to prove that. I mean, many of NBFC lenders have done surveys which shows that people are taking multiple loans. Now again, why is this happening? So one simple reason is banks moved directly to lend to consumer and indirectly through NBFCs. Non-banking finance companies are also big lenders. Something like 70% of credit of non-banking finance companies is to consumer. So that was what I call the supply side effect. On the demand side, households started doing aspirational consumption and started probably spending way beyond what their earnings would justify. But also, you have to bear in mind that credit is much more easily available now. Because of technology, you can now get credit as transaction point. So a lot of these buy now, pay later programs, for example, what are these? They're essentially making credit available at the point of transaction. You go to buy a shirt on Amazon, you are asked whether you want to convert it to EMI. Today, everything is bought on EMI. That is the unique development that happened in the last 4-5 years. And that's why this credit took off. Because now it's so much easier to deliver credit. Prior to that, the only transaction-based delivery of credit could happen through credit cards. Because you swiped at the credit card at the transaction point and you got the credit. Now there are other means of doing it through these online platforms. So I think as a combination of all these factors, this credit is taking off and is therefore probably creating concern in the minds of regulators.
But, so you would expect that the impact of this change in regulation would be that the banks would have lowered their rates of lending to.
Yeah, growth rates would have come down.
But that doesn't seem to have happened.
Well, it's too early. So this thing came about 3-4 months ago. There is some dampening, but not meaningful. We would wait and see whether this really goes down. But there could be other.
So Hindu Business Line reported in January that it actually increased by some percentage.
Yeah. So if you look at from a lender standpoint, what does this mean? This means that instead of putting, let's say, 100 rupees of capital behind a certain loan, now I have to put 125, which means that on that additional capital I have to earn return. Okay. If I can charge my customer more and earn that return, then I don't care. So effectively what this would have meant if the growth does not come down is that either the banks have been able to pass on the additional capital cost to their consumer, or they had already had enough margin that they said, look, I'm willing to take lower margin, but I don't want to bring down my growth.
This doesn't affect.
And it could, and therefore the outcome could be a combination of both of these, which is that banks on the one hand could pass on some, if not entire 25% additional, and partly they said, fine, I'll accept a lower margin, but I want to keep growing at 20% plus. But I think we'll have to wait for some more time to really see what happens in steady state. I worry about something else, that if indeed there is a bubble, then at some point in time it will burst. And you have to bear in mind that consumer credit formally, in the formal sense, started in India around 2000. Before that, we really didn't have, banks were not lending to individuals. So it's not very old. And more importantly, within that, we have never seen a consumer credit bust. Like we see a commercial credit NPA cycle, multiple cycles over the last 25 years, we haven't seen one in consumer credit. And I don't think as a banking system, as a regulated financial system, we are ready to deal with that. I'll tell you why. We don't have a bankruptcy law for individuals. So today, if an individual declares bankruptcy, basically somebody throws his hands up and say, look, I have 4 loans, I can't repay any of them. We don't know legally how to deal with it. Which means that banks also don't know how to recover this money. They will have to write off everything. But it has broader societal consequences. One of the things we have noticed in other countries is that in consumer credit, there is a greater risk of contagion. What it means is that if I as a borrower see a friend of mine who's also a borrower and defaulted and nothing happens to him, then I say, well, I'm not an idiot. I'm not going to pay back. I'm also going to default. So these defaults can spread very fast, way more than what happens in business credit. We haven't yet seen it, but there is always a lingering worry that if there is going to be a consumer credit bust because households are borrowing far too much, then you might see that, and then it spreads like wildfire.
Also, there are no assets to recover from.
There are no assets. I mean, unsecured credit, there's no assets. And even in secured credit, I mean, home loans have been around for a long time. There are a very small number of cases where lenders have actually been able to go and recover a home and sell it and recover their money. It's also, I mean, it happens a little bit more in cars, but the recovery rates are very low because value of a second-hand car is much lower. It takes time to sell it and so on. That's why, in fact, I don't call them secured. I call them quasi-secured credit. It's notionally secured, but actually not. And so, therefore, it's a problem both for lender, but it could also create a social issue. I mean, I can easily picture morchas coming saying, oh, lenders are charging too much. Between 2010 and 12, there was a microfinance credit bust in some parts of the country, Andhra Pradesh and all. And this is exactly what happened. Villages after villages defaulted in Andhra Pradesh on microfinance loans. And that was a classic case of contagion. And then there had to be some regulatory changes and a lot of things followed that. So I fear that something like that could easily happen here. It hasn't happened so far. If you speak to lenders, they will all assure you that no, our risk is well behaved. We track it very carefully, which may be true. Which may be true at least for some of them. However, just the rate at which this credit is growing easily could concern people who observe this space. The final point there is, which something that I wonder about more than worrying about, is that essentially what this trend tells us is today between direct banking credit and indirect banking credit to NBFCs, non-banking finance companies, 40% of the system credit is going to consumer, which is more than what is going to businesses. Because remember, there is also agriculture and so on. And so effectively, all consumer credit is what called a demand side credit. It is supporting demand in the economy because consumers are going and buying something. Business credit is our supply side credit because it's basically creating supply of goods and services. So in the last 10 years, we have moved from credit going to the supply side to credit moving to the demand side. Now, given the state of development of our economy, one wonders where this is premature. We call India an investment-led economy. We have to keep growing at a very fast rate. That requires investment. That investment comes in the form of creating new capacity and creating higher capacity to produce goods and services. And yet credit seems to be going towards the demand side, which I don't know how sustainable this is. In fact, some time ago, co-author and I, we wrote an article and we asked this question, therefore, is this shift to consumer credit cyclical or structural? Cyclical means that then it will rebalance and banks and non-banking entities will start lending to businesses again. So far, it hasn't happened. In fact, the share of consumer credit keeps going. So that's the kind of macroeconomic implication of this trend.
So does that mean that there is more money going to support consumption than in making assets?
Well, very broadly, that's what you can say, that effectively this is credit going to support consumption. This has always been the case in countries like the US, where 60% of GDP is led by consumption. This has not been the case with us. At the stage of our growth and development cycle, we are far more investment-led. So everything else being same, greater amount of credit should go to support investment, which clearly is not happening. Now, there are also other reasons that investments themselves are not happening at the rate they ought to be, or private investments. But that is exactly one way of actually interpreting this trend. that the credit is going towards supporting consumption. Now, another implication of that is that financial savings in the system are falling. So we have already, financial savings should be 11-12% of GDP, now we already gone below 10. And that is reflecting in very or lackluster deposit growth in banking. So on the one hand, consumer credit is growing, but deposit from households have been basically stagnant and individuals for the last 4-5 years. Because I think what is happening is that after repaying loans, households are just saving less. So if you imagine that I have my gross saving, which is my earning minus my household expenses, that's my gross saving. But then I have loan repayments, which gives me my net saving. So the difference between the gross saving and net saving is widening because households are getting leverage. They're borrowing far too much. So there are all these second, third order implications of this trend that we would see unfold over the next many years. And a lot of them are quite worrisome. And I think that's probably one of the reasons why RBI said, look, let me apply some brakes and let me cool this off. Now we'll have to wait and see whether that actually happens.
There are also very interesting ways of accessing credit now. So you can download an app from the Play Store and then...
Yeah, which is what I meant. So the more important change, especially post-COVID, has been just incredible ease with which especially this unsecured credit is delivered. I mean, on every e-commerce platform, you have EMI options now. You go to a Chroma and you want to buy a coffee machine, it says whether you want to swipe a credit card, it can convert into EMI, or you get a loan at the instant of actually purchasing the particular item. So I think that ease of actually delivering credit has very significantly contributed to this growth of consumer credit.
So can you shed some light on how we got here? So how we began in 2010, what the shape of consumer credit was back then, and then...
Yeah, so as I said, consumer credit began in around 2000. And for me, the marquee event was when ICICI Bank started doing home loans. That was the year 2000. If you go back to the 1990s, we had only public sector banks. We had some NBFCs which had begun to do some car loan kind of thing, but they were fairly small. So really we had public sector banks and we had chota-mota NBFCs here, there. Some of them were doing vehicle finance, and then there were some foreign banks like Citibank and also to do some consumer credit. We had also very small, thin card-based credit cards. That was all until 2000. It is in the year 2000 when this whole new crop of private banks, ICICI, Axis, in that time it was called UTI, HDFC, or Kotak became bank in 2002. All of them started doing consumer credit. So consumer credit is, I still call it, is in the first generation of its existence in India. It's just about 20 odd years old. And as a result, now along the way there were many important developments. For example, development of credit bureaus, which aid lenders assess credit risk. That happened around, they were around for a while, but there was a law change in 2010 or 11 thereabouts, which made it mandatory for lenders to share information with credit bureaus, which actually made lending much easier. Underwriting credit risk became much easier. So those were the development, then development in technology. And then what happened in the late 2010s, 2015, 16, there was this groundswell of non-banking finance, so-called fintechs, which are nothing but a technology-enabled non-banking finance entity. They all came up, and there was a lot of capital that went into them, and they started lending, either directly and now lately through partnership with banks. So all of that combined with the fact that business credit remained very lackluster in the last decade because of slowdown in the economy and so on. I think all of these contributed to getting us where we are right now. And I think therefore the next 2-3 years will be very crucial. If this trend continues, then we are going to be in a bit of an uncharted territory, both from a regulatory point of view, but also macroeconomic point of view, as to what the implications of this trend are. Or we might actually move back and to sort of mean revert to our old
cyclical or systemic.
So that was, it's a cyclical or structural question. We might get the answer in the next couple of years.